Hey everyone, thank you so much for watching this video and for spending some minutes with me. Today I want to talk about timing the market and how difficult and impossible it is. So what you see on the screen, these are real numbers. In 2018, around October, I had a 401k with $30,000. This was invested in the Standard & Poor's in one of the mutual funds through my 401k. And the market back then was at 2885 points. So I decided to sell, and basically I did that because I was reading lots of news on the websites, on different websites, that there was a market crash coming. I really got scared back then, and I decided to sell. And so, I thought I would be able to time the market, sell, and then buy again when the market was cheaper than that. And so what happened is what you see in this chart up here. I've never invested the money back. So the market today is at 41.37. I've not been able to make any extra money because I've not reinvested my 401k. And so if I had kept the money in the market, at some point in early 2020, the market grew to 33.80. So I would have made an additional 12% back. But then a month later, the market fell about 32%. This was because COVID, and it went to 23.04. And then since then, the market has grown again to the 41.37. So as you can see, I removed the money from my fund in late 2018. And if the market today fell about 30%, I would be more or less at the same level I was back then in 2018. So it's taken another 5 years of ups and downs to get to this point where we are today. And, I keep reading articles and news that the market is going to crash big time, but obviously 30% today is not the same as 30% back then. If the articles I read back then were correct and the market was expected to crash 30%, then we would be much below the numbers of 2018. And so this shows a little bit how difficult it is, the market, because it's difficult to find the right moment to invest again. Yes, you may say, yeah, why don't you invest here? Why don't you invest there? Because when you are at that point in time, you don't know what to do really. Like today, right? So the market is here. We don't know if the market is going to go up or if the market is going to go down. So this for me has meant that I've actually not lost, but actually this is the cost of opportunity. I could be now in a 401k with $43,000, and instead I'm in a 401k still with $30,000. So let me scroll down a bit here for you. Let's suppose that today we had to make a decision, right? We have a few options. Either we keep the money in the market or we decide to invest today, right? So we could decide to invest right now or to keep the money invested if you have it invested. And then you have two options. The market goes up or the market goes down, right? Let's suppose that instead that you decide to sell if you have the money in the market, or that you decide to wait and invest later. The same could happen. Either the market goes up or the market goes down. So all these different scenarios, and these are the only possible scenarios you have, two of them are positive for you and two of them are negative for you. So if the market goes up in this case, you are making some more money, so that's in green. If you invest the money but the market goes down, you are losing some money. If you don't invest, you decide to invest later and the market goes up, that's the cost of opportunity because you could be making some money, right? But if you decide to invest later and the market goes down, then your money is safe and then you are not having that loss. So I'm trying to reflect that here. These different scenarios are scenarios that represent how you can feel. Like in my case, this is what I am, right? I decided to sell my fund and to maybe try to invest a bit later. So I feel a bit silly because the market went up. Now, if the market instead had gone down, as those articles said back then, the market would go 30% down or 20% down, then I would feel very smart because I would be making some some money by not having those losses. And this strategy here, I call it the feel great strategy, because yes, you decide to keep the money in the market and the market keeps going up. That's what happened. And if I had kept the money right all the way up, then I would be feeling great because I would have 30% more. So I would have $39,000 in my, or actually this is $43,000 because that's the reality, right? This is just an example. And the other one is where you feel stupid because you keep the money in the market, but the market goes down 30% in 3 years. Then you are actually, the value of those shares for you are just $21,000. So I don't know which strategy of this you like the most. I'm in this one at the moment where I feel silly because the market went up over the past 3 or 4 years. And now I'm at a point where I need to make another decision. After following this strategy for a while, you start to think like, okay, should I keep just staying on the sidelines? When is it going to be the right time for me to invest? So I have some additional numbers for you. I'll try to make another video for next week. So please stay tuned. I think that's it for today. Thank you so much for watching. If you have any comments or any feedback, just let me know. I'll be happy to chat with you via the comments. So take care and talk to you soon.